The broadcast is now starting. All attendees are in listen-only mode.
Hey everybody, how's everybody doing today? I know I'm in a little early. I always try and get in, just make sure everything's working okay. Looks like everything's good to go. All right. I'm on a group text for my kid soccer this weekend, and the coach specifically said, if you are not going to be there, let me know ASAP. And everybody on the team right now is texting that they will be there. It's so annoying. So if you hear my phone buzzing, that's what it's all about. Wolf, how are you? You making money as usual? Yes, I'm trying to. I don't know if you guys saw that clinic I put on with Coca-Cola recently, but it was literally on basically trading short calls, just managing risk on an underlying I had put to me. It was pretty epic. Now I'm trying to do the same thing with IBM, which is the stock that got me involved in trading options way back in the day. My first options trades were around IBM and Walmart. All right, let me get this set up to record. Hey, looking into short Coca-Cola. Oh, you know what? I was actually looking into, I originally thought we were doing the short call butterfly and was going to use that as an example today. Did anyone else have a problem viewing the video from last week? I wasn't able to review it. I don't know, Mesa. Reach out to us at trading. I didn't hear anybody else having a problem, but that'd be good to know. All right, let me get this set up to record and we'll get started here so you guys aren't here. We're already recording, ladies and gentlemen. It looks like, just to make sure. All right. This is being recorded, you guys. Something I mentioned at the beginning of every single webinar is watch this again. Why? Because it will help sink into your long-term memory. Two, especially with butterflies, you guys, long call butterfly, short call butterfly, all of the butterfly families besides the iron butterfly. But these butterflies are a little bit bizarre in that they don't necessarily follow all of the specific rules that we lay out there. These are, like a lot of times you'll hear me saying 99% of the time. Well, this is one of those 1% of the time where on a long call butterfly, we don't necessarily have all of the exact structured rules. I'm going to show you where those rules flip and why. Because really, on the surface, it's a long call butterfly. So you think that, you want longer duration and things of that nature. Well, I'll show you as to why that doesn't work out necessarily in this specific strategy and why that it's a little bit different. Like we want theta decay with this one as opposed to a regular long call, let's say. All right. So let me get a couple of things out of the way real quick. My name is Eric Wilkinson. You guys might recognize me from mainstream media as the Wolfman, where I've talked about everything from economic to geopolitical and my market analysis on top of that. I do the same thing still to this day. I do it a lot in my daily market commentaries where I go over all that stuff, and I talk about these options trades that I'm implementing into my portfolio on any given day. Couple of things also. I started out in college trading some money I'd earned. I mentioned before we got on here, at least I think before I started recording, that IBM was one of those trades that I got involved in earlier on in my career, trading options around it. I'm doing the same thing in these daily market commentaries right now. Did I Photoshop the cup? No, that is me. Coming up short, there is a bit of distance there. You can see I came up a little bit short. I was a little nervous. I'm kidding. But that was when the Blackhawks won the Stanley Cup back in, when was it? I don't even know right offhand. But anyway, so I started trading in college around stuff like IBM, Walmart, and moved to Chicago, said this is the thing for me, and jumped into the pits. And in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all those products in just about all market conditions. All right, this is on the long call butterfly. Again, I also, at the beginning of all these webinars on the roadmap, I want to put that on the shelf right now because we never go into a strategy or into a trading day saying, I need to put on this strategy today. Now, I do believe you shouldn't be a one-trick pony, and you should have a lot of different arrows in your quiver in order to put out there and trade around on any given day. You don't want to always just use the same strategies for, say, a market neutral assumption, because it's good to filter in some of those other strategies as well, because it'll help you with your probabilities of success. All right. So we're putting this on the shelf, and here's a couple of things we're going to talk about today. The directionality. Specifically, when we come up with an assumption on our directional move of this underlying, that's the first thing we come up with, right? So I'm going to show you, once we've come up with that directional assumption, where's the destination we think that this underlying is going to go? What's the underlying environment around that specific stock, ETF, future? And what I mean by the underlying, we're talking about volatility. So we're specifically going to talk in and around that. What is the specific duration that we are going to need for this particular strategy? And more importantly, or maybe one of the most important things, is our strike location. And when we're talking about strike location, specifically with this one, is how much of a credit should we be, or how much of a debit should we be paying versus our reward, our risk reward, and all of that. All of those nuances are really important to determining our strategy and our probabilities of success. So I go into that. It's not like just going out there and, yeah, all right, well, with this one, we're selling two at the monies, and buying a further away option strategy or options to define this risk, whatever you might read online, and or hear from other people. I'm going to specifically go into details on that. All right, but a couple of things. I know there's some new faces out there and some returning veterans. So this might be a little bit of a review for you all, but some of the newer people, I want to give a little taste as to how I teach and why I'm looking at these things. But delta, we always talk about, is data. It gives us all kinds of things. It's not only the effects of the options premium in relation to that underlying move. So when we're talking about this, though, we're talking about a first dollar move in the definition. And throughout this webinar, I'll talk about the different delta and the data that delta gives us. But first off, let's just talk about delta as regards to this underlying XYZ, let's just call it. So with XYZ, what we want to look at for delta is, let me get rid of this because it's covering up my number there. So when we talked about that first dollar move, we're talking about it going from 148 to 149.35. I know some of you guys have already gone over all of this. I just want to use this as the example. So we're looking at delta here in this column. So 45 cents on that underlying move to 149.35. 45 cents goes into the premiums over here on the corresponding strike. So $1 move higher, our premiums over here would then now be $4.05 and $4.20. Okay, so on the first dollar moves, that's what our premiums would look like in the bid offer for that particular strike. The 150 strike is what I'm looking at over here. All right. On the flip side, we've got delta over here. It's negative. All right. So delta is going to be negative for the puts all the time, because the assumption with all of these Greeks is we're going to move higher, we're going to move further, we're going to move out in time, all of that. If you get a negative move, a negative dollar move, then you have to take that into account. But on a positive dollar move, our premiums would decrease by that 38 cents on that corresponding 145 put. All right. So a dollar move higher, puts will decrease, the calls will increase. Well, what do we talk about when we say a dollar move down, right? If we had this go down to 147, well, then a negative dollar plus a positive delta makes that a negative delta. A negative dollar plus a negative delta makes that a positive delta. So if we were moved down, the calls decrease by that corresponding amount. The puts would then increase by that corresponding amount. All right. So pretty simple. So we said this was dollar number one. Gamma, we're talking about dollar number two. So gamma goes with delta. All right. So always remember, gamma goes with delta on the second dollar. Gamma doesn't really do anything on the first dollar, but on the second dollar move, we will see it add in there. So gamma goes with delta. So here, gamma goes with delta on that second dollar move, because now we're at 150.35, right? We've gone up $2. This was dollar number one. This is $2 over here. So now our increase would be 48 cents for these 150 calls, right? So now we're talking $4.53, right, on the bid, and then $4.68 on the offer. All right, $4.68 on the offer. On the flip side, we go up $2. We've got a negative delta plus a positive gamma. Well, then that second dollar move higher, we would only lose 35 cents, right? Because we got a negative delta plus a positive gamma. It only decreases by 35 cents. Now, if we're talking negative dollars moving down, then, you know, we would have had a negative delta over here. The next dollar move down would have only decreased by 42 cents. And over here, the second dollar move down, those premiums would have increased by not only the 38 cents on the first dollar, but another 41 cents for the second dollar. So $2 move, we would see that premium increase by a total of, trying to do the math in my head right now, of 79 cents, right? $2 move down, these premiums would increase by 79 cents, right? First dollar, you get 38. Second dollar, you get 41. All right, so those two added together gives you that 79 cents for a $2 move. Does that make sense so far? I know it's a review for a lot of you guys. All right, so Theta is the thief in the night that comes and steals our premium. All right, he's the thief. So just always remember, Theta's thief. Every day that goes by, that guy comes in or that gal comes in and steals our premium. So we can see that Theta in both columns is negative. All right, Theta is always negative. Why? Because we can't go back in time. We're always moving forward in time. So every day that goes by, we're losing Theta. As a matter of fact, you go a half a day, you would lose half of the Theta, right? So the idea is every day that goes by, like 6 cents would now come out. We show up tomorrow morning, 6 cents. All other things being equal, XYZ is still trading exactly where we were. Nothing else has changed. 6 cents would come out of the 145 puts and 6 cents would come out of the 145 calls. All right. Can't go back in time. So Theta is that thief in the night. One thing to say about Theta. Theta is more aggressive the closer we get to expiration. All right. 5 days, 1 day, inside of 7 days, it really gets aggressive. Inside of 45 to 35 days being the real sweet spot, that's where you start seeing Theta really start to pick up. All right. Further out in time, Theta's not so aggressive. But the closer and closer you get to expiration, it's more and more. It goes from 6 cents to 7 cents to 8 cents to 10 cents, and inside of 7 days, you can see that being the entire amount, right? All right, so Theta is the thief in the night. Vega is the measure of change in volatility. So when we're talking about Vega, we're talking about this, and this is actually implied volatility, all right? Implied vol is what Vega is. And you can see it's 26.57. So we're always increasing. So this is an increase of 1%. So if we go up by 1%, right, that now we're talking 27.57 in this column. So all of our premiums would then increase by the corresponding volatility. So, you know, we could see those premiums increase by 18 cents. You'll notice that Vega is positive on both, all right? Because as premiums increase, volatility increases, all of the premiums are going to increase across the board. And as volatility decreases, all of those premiums will decrease, all right? Notice that the at the monies, the ones that are really close in here, all right, are being affected the most by the volatility component, all right? So at the monies are more susceptible to volatility changes up and down, all right? So that's something we need to keep in mind with this specific strategy, the way that I set it up. And volatility will flex the further duration options a little bit more. So as volatility is expanding, that's where you would want to be in volatility expanding if you had bought something, all right? If volatility is contracting or is really high and you expect it to come in, then this is kind of your wheelhouse inside that 35 days to expiration when you're selling premium, because you get the theta component and the volatility contraction component kind of working in your favor. So that's what we usually look at with my rules. If we're trying to collect a big fat premium, we're going into the closer to expiration strategy or expiration option montage. When I'm talking about option montage, that's basically this page. Trevor, I see your question. Just let me get this thought out of the way. All right. So with this strategy, or with high volatility, you want to kind of go, when you're in a high volatility environment, you want to go closer to expiration, because theta will erode and so will Vega when it comes in. It will really help you out. What happens to theta as volatility expands and contracts? Well, theta is going to remain the same for the most part. It will adjust slightly, but it's more going to be the Vega that expands and contracts. As volatility starts expanding, the Vega column is going to adjust a lot more than that theta component, all right? All right. Deltas are going to change as well. So as volatility expands, deltas will expand as well, all right? And the reason why that is because delta not only tells us how it changes the premiums, right? But delta also tells us the probabilities of something happening. And if volatility is expanding, that means the probabilities of a bigger move are more likely, all right? So the deltas across the board on all of these option montages are going to adjust as volatility expands. Those deltas are going to expand as well. Okay. So another thing is, when you're in high volatility environments and those deltas have expanded and stuff like that, what that really tells you is, you guys, you know, I usually talk about deltas a lot in all of my webinars and in the daily market commentaries. Well, that's because I'm talking about the probabilities. And I know that when volatility has expanded a lot, and I'm still talking about that 16 delta, I know that when volatility is super high, that 16 delta is much further away from where the at the monies are than when volatility is really low. All right, that 16 delta might be very close to where the underlying is trading. Okay, but as volatility expands, the deltas expand as well, and you can get further away, which is always a key here. All right. All right, so let's get into it. Where are we going? The idea here is I have a trade on, and it's not Coca-Cola. That's the other one that I was looking at. And it's for BABA. All right. So right now, BABA's experienced a lot of things. You know, we can talk about everything that's going on at Alibaba. That's not really what I want to talk about. I think that it's going to settle down in and around here. So the idea here is I have a market neutral assumption in BABA. I think a lot of, you know, the news has been out there. There's a lot of rumors flying around. And that's kind of the time where you see that volatility expand. And I think that it's going to go on the back burner and media is going to stop talking about it. It's going to settle down in and around a range. So what we're talking about here is with BABA, let's just say we're going to BABA and it's right here. So we know BABA is right here. What we need to know is then what's our directional assumption? Well, I've pretty much got a pretty neutral directional assumption here. Where are you going to short BABA? Well, I just think BABA is going to stay in a tight range. And do I think I'm going to short it? No. I think it's going to stay market neutral. So I don't want it to be bearish. I don't want it to be bullish. I want BABA to kind of start settling down right here in and around where we currently are. So, you know, if I'm starting out here, I want BABA to kind of stay within the certain range and really end up exactly, you know, where we are. I don't care if it moves around and stuff like that, but I want to make sure that it is in and around. I don't want to go super far north. I don't want it to go super far south. I want to kind of trade sideways here. All right. So do we have a good destination? I've come up with this assumption, flipping through the charts, and found BABA on the charts. I haven't even looked at the option montage yet or anything else, but I have to look at BABA now and say, I've got this directional assumption. How do I take advantage of a sideways market with options? Can I even do that? So I need to go into the option montage and find out if there's a lot of things going on here, right? Does Chicago, does BABA have a lot of eyeballs? Are there a lot of things to do? Yes, in Chicago, you can go to Navy Pier, you can go to the Bean, you can go to Sears Tower, or wherever they call it these days. You know, there's all kinds of things to do there. Well, that's because there's a lot of eyeballs and there's a lot of things going on there. Well, the same thing goes with an option strategy. How do I know if it's a good destination? Because there's a lot of open interest. There's a lot of things going on there. There's a lot of people there. There's a lot of eyeballs. Free market price discovery is in full swings here. All right. So that's what we're looking for. And that's what I mean by, do we have a good destination? So with that being said, I've got the wrong chart up for the next one. So let me pull up my platform for this thing here. Let's go over to BABA. Hopefully I have it up. We do have a BABA trade here. All right, so my rule for this is on a stock that's over $100, we move the decimal 3 ticks to the left. BABA is obviously over a $200 stock, and 1, 2, 3. So 26 cents wide in the bid offer. And I'm looking at the options montage monthlies that are closest to 35 days to expiration. Why do I do that? Because that's on the floor what we used to call the spot month. That's where basically most people are starting to trade in there. And therefore, we have free market price discovery in full swing. All right. So when we're looking at any option strategy or any underlying to see if it's tradable in the options, this is the rule we're looking for. So 26 cents, I need to look at these options that are kind of just out of the money or right at the money to see if it fits that rule. And you can see that it doesn't necessarily here. And that's because it's after the close. So let me see if I can find my actual page that I was looking at for this strategy. I'm going to have to go really far away. Let's just look at this one, because this is, I took this snapshot before the close. So you can see 26 cents wide from the bid offer. That's 30 cents. You can see though we've got right around 30 cents there, 30 cents there. Of course, when I took the snapshot, it didn't work out, but 35, 20, 30 cents. So this is specifically outside, slightly outside of my rule here. So my rule for this is, like I said, when we're looking at this strategy, move that decimal 3 ticks to the left. We want to make sure that if it fits that rule, that is a green light, right? So with this, we're looking at moving the decimal 3 ticks to the left. 26 cents is what I'm looking for in the option montage right down here, and just outside the money in the puts. Now, when we're talking about, that would then be a green light. If it fits my rule, that's a green light. 2 times the rule, somewhere between this and 2 times the rule, that makes it a yellow light. All right. and 3 times the rule is a red light. What we have here looks like a bit of a yellow light on this underlying, okay? Specifically this underlying, this is what we're trying to determine. So now we know we have an option strategy that is a little outside that range there that we're looking for specifically. So we know that we have to proceed with caution in a sense going forward here. Now, find the right strategy or right page that I was on. So this is the one that I had up, but let me find another underlying that we can take an example of real quick. So if it's a stock that is less than $100, like Procter & Gamble, then we need to make sure that during open market operations, it is 10 cents or wide, 10 cents wide or less. And that's during open market operations. So my rule, let's go, if it's less than $100, my rule is the green rule is going to be 10 cents wide, less than $100, 10 cents wide. And that gives us our green light, all right? So that would then therefore be a green light. If obviously it's 2 times the rule here, 2 times the rule on less than $100, that's a solid yellow light. 3 times the rule on something less than $100, you guys, walk away. Please walk away. I might even walk away from a 2 times the rule on less than $100, all right? But during the open market operations, we will normally see that work out on most stocks across the board. So over $100, move the decimal 3 ticks to the left. Under $100, 10 cents or wide, all right? Can you tell us why you think BABA will trade sideways? Yeah, I'll get into that a little bit more as we go. Here, I've got the chart up. We've had all this volatility. It's come back down right in and around this area here. And I think that we're going to see it kind of bounce back and forth here until there's more news. And I don't think there's going to be any real news about BABA for a little bit. And that's going to get this volatility to come out a little bit. This trade, you know, is a quick in and out kind of trade. You get that settling down to this underlying, it kind of pops back and forth right where you are, and you get that volatility coming out. That's the perfect storm for the short iron or the long call or the long put butterfly, okay? You get that high volatility comes out, the underlying stays right there. That is the key to this strategy. Why do I think BABA is trading sideways? Well, I don't necessarily know that I would put this on, but it's a good example of it wanting to trade sideways. I talk about the real trades I put on a lot in the daily market commentaries. This one really fit the rule very well and gave me a perfect example on why we would use all of my rules around an underlying like BABA if we had that market neutral assumption versus something else that doesn't necessarily fit all these rules, all right? So we'll go through that. But let's just assume that I've got a ironclad reason for it. You know, maybe it's the Fibonacci's or whatever. But for right now, I do actually think it's going to settle down and move sideways. We've got this nice solid bottom here. I don't think it's going to go any lower than that. And I think we're going to kind of build out up in this area right here. I think Alibaba also has it priced in. You know, everybody knows to stay at home. These guys have been doing very well, as well as Amazon or eBay or anybody else. All right. So now we got to take a look at BABA's environment. What kind of, we already have the neutral market assumption. We know BABA has some good volume and open interest. It's a little bit sketchy on the, you know, fitting my rules. It's the yellow light for sure. But the environment, we want to check out the environment. Do we have low volatility? Low volatility, we can think about it as being sunny, there's no risk on the roads, right? You can see 3-4 miles down the road. Whereas when it's rainy, you know, you're kind of white knuckling it. Tensions are high, volatility is high, is how I always looked at it. As, you know, when tensions are high, white knuckling it, you know, you want to get straight to your destination. You want to get in and out quickly to that location. Whereas when it's sunny, you don't care if you're walking for blocks to every destination and all of that stuff. You want to take your time. So, but what I'm really talking about here, for people that like to dig into the devil of the details here, I have a rule of thumb here that we look at, and it's current implied volatility minus the low IV. You take that sum and divide it by the high IV. I don't want to lose everybody here with all the math. People are being like, I didn't come here for a math class. Well, I've got an easier way to look at it. All right, so basically you take this fraction, and what we're trying to do is find out where the current IV is. Ultimately, we want to see where current IV is in relation to where, say, the high IV is and the low IV. That's not a very good, I don't know what I just did there. I was thinking ahead of myself, I guess. Trying to make that line work for what I wanted. So basically what we're looking at, thinking on that line. So basically what I want to do is find out where current IV is in relation to where high IV is. All right, so something like that. I want to know where this is in relation to the high and the low, okay? Because I know when it's down here at these points, right, I know that that premiums are pretty cheap. And when volatility gets up at this area, I know those premiums are pretty expensive, all right? So ultimately what we're trying to determine is, are the premiums expensive or cheap for this underlying? All right, that's what current IV tells us in relation to the high and the low. All right, that's the only way, because every underlying's current, high, and low IV are completely different. All right, well, they might have the same current, but that current could be very high for one underlying, and that current, 26 could be high for one underlying. It could be super low for another underlying. So we can't just look at implied volatility and say, hey, implied volatility is 26. That's really low, because I'm looking over there at Tesla and I can see that Tesla is up around 90. That must mean that McDonald's 26 is really low. No, it doesn't. It doesn't correlate that way. All right. What we have to look at is 26 for McDonald's high or low, and is 26 high or low for Tesla? Tesla will never get down to 26, I don't think. So that would be really low. All right. So we need to determine whether or not implied volatility for this particular underlying is high or low. All right. And why does volatility matter? It's because when volatility starts going up, our premiums go up. And when they go down, our premiums go down, right? So if we are selling this underlying with high IV, we want the volatility to go down. We want to get in an environment where we see that contraction or the expectation of volatility going down, all right? And the reason why is because when we're selling volatility, or when we're selling premiums, we want high volatility, because that high volatility means high premiums. You sell high, you buy low, and when volatility is low, we're buying premiums. Now, with this strategy, we're doing both, all in the calls. We're buying calls, we're selling calls. But one thing I want you guys to remember is, with this strategy, we're selling. Remember, we're going to be buying a further out of the money call. We're selling two at the money calls, and we're buying an in the money call. All right. Now, that defines our risk. The two we're buying defines our risks on the calls. But remember what I said about those premiums in the option montage? The ones at the money are affected by volatility the most. So if we can find something where there are really expensive premiums at the money there, well, that's what we want that volatility to contract on those, because those at the money will be affected the most. All right. So those are those are the premiums that are going to be able to contract the most. All right. So when we're looking at the option montage, here you go. I have my implied volatility chart down here. And we can see that underlines will stay in a relatively tight range on their options. Now, I always say that I think that this is out. I think that the news is out about the coronavirus, right? We're learning a little bit more and more about that every day. So we're not going to see this kind of fear, since like 1984 was the last time we saw this fear, or even further was 1929. We didn't even see this kind of fear or this kind of spike in the VIX or any of these implied volatility for the underlines, even during the Great Recession, okay? So I think that's out of the question. I think 2019 is out of the question. I don't think we're going to see that low volatility. I think the 20s for the VIX is the new teens for the VIX. So my idea is let's look at things that are from here on out, all right? So what we can say then for that would be we're looking at the high and the lows and stuff like that. We can look at it like pretty much that this is the high across the board. So it's not a very straight line, but that's pretty much the high. And we'll say that this is the low going across. Something like that. So you can kind of see that it wants to stay within those ranges. I always say when the volatility is really high, it's going to want to revert back to the mean or back to the middle, which is about that 50 IV, right? So I think that it wants to revert back to that area there, or head towards that lower threshold. So I think the volatility is also coming out of this underlying. So when we're taking a dive into that strategy or that mathematical equation that I was looking at, again, when we're looking at the lines in the sand here, we can say that right around here, we'll just draw that line across. It's not perfect. This is probably a little bit better there. Say that's the low, probably right about there. All right. So we've got our high. We'll say that this is 56, 31. All right. So we've got our high, we've got our low. We can see on this chart right now. So this is your streamlined way to do it, is kind of pick out the high and the low. We also talked about it wanting to go back to about the middle. Thought that was a straight line. Sorry. Thought we would go back to the middle there. On this line, right? Go to the middle of about where all of this is, just making it quick and dirty. That would be about middle of the road of my range. So obviously volatility is in the upper range of this chart here, right? And we expect it to revert back closer to that middle of the road. So that's one of the things we're looking for in this strategy. The other thing that we're going to be doing is you could look at it if you want to dig into those details and say, remember the current IV minus the low IV, take the sum and divide that by the high IV minus the low IV, right? So we've got the current is 49 minus the low 31, and that sum divided by the 56 minus the low, which is 31. So we basically have 18 divided by 25. So 18 divided by 25 basically makes this 72. All right, so 72, 72nd percentile. If we did it with this high and this low, it basically comes out with 53. All right, that's the way the math works out with TOS or the script that I have. It takes into the last 52 weeks. It goes all the way out there. All right, but to me, I think we need to look at from here on in, kind of thing. Does that make sense already? All right, so you can ballpark it as well. I have no problem with that. Rudy is saying, why not use the IB on the option page? Now, I'll pull that up here in just a second. One of the reasons is because, like I said, I want to take out that because I think it's an outlier. I think it's a black swan event. We might not see it for another, 10, 20 years, okay? I also don't think that we're going to see this super low volatility for the rest of this year. And when I'm putting on this strategy, I'm not looking out that far. I'm not looking at a strategy where I'm out to 1 to 2 years out even. My strategies will maybe go out a year. That's about as long a horizon as I look at. So my rule here, though, for selling premium and things of that nature is when it's greater than 50%, we want to sell premiums. And when it's less than 50%, we want to buy premiums. All right. Now, you guys might be thinking, all right, taking that off the shelf and saying, you're talking about a long call butterfly. That's a buy, that's a debit. So that means that we're buying, right? Yes, it does. But with this strategy, that's why I said the butterflies kind of blow it out of the park. We're selling to at the money is the way that I build this strategy out. When we're doing butterflies, call butterflies, iron butterflies, put butterflies, any of those types of butterflies, I look at the monies for these, okay? If you think it's going to go to a certain strike location, I've seen people set the strategy up where they do a long call butterfly and they put it up, 20 ticks higher, and they're selling those out of the monies 20 tick higher because they believe the underlying is going to go straight up that strike and nail the number, pin the tail on the donkey. They're going to just, hit the bullseye, right? Listen, I think that why not go out there and buy that strike location as a call if you think it's going to go there? You're risking a lot less for this same amount of probabilities. You're risking a less and your upside is much better. So if you think there's a certain target, then play the strategy for that certain target, not a lower probability strategy like this, trying to pick a strike location way up higher, all right? That just doesn't work. Rudy, did I answer your question why I don't use the option montage? One of it is the options montage says, all right, from this day all the way out to this date, we're taking all of the data into account. I don't think that this is going to happen. I don't think that this is going to happen. So therefore, I want to just look at the data from here going forward. All right. So that's one of the reasons why you need to know this fraction. If you want that finite number, like we can pull up on what Rudy is talking about, why not just look at the option montage? What he's talking about is right down here. So if I look at BABA down here, close out all this stuff, 53, that's at 53 percentile because and I have the script to put over here, 53.11, is taking into account all of this. It has to. It's just the way that the script is working out, and it takes that into account. So right now, I think it's really important to just kind of, and I don't have a problem just drawing a line there and kind of, okay, look there, maybe that bottom's a little bit out of whack, but just try and ballpark it. All right, I think premium's coming out. That's one of the more important things. I don't think premium's going to expand anymore, but premium's pretty high, and I think it's going to continue to contract. How would you adjust if the price blows through the tent? Well, with this one, you're not going to be able to because, your risk reward is pretty good already. You're going to risk 1 to make 2. And if it blows through and outside of it, those long calls are not going to be able to be adjusted. All right. The shorts are going to be, either way out of the money and starting to decay, and it's getting offset by your long call there. It's going to mess it up. So usually with this strategy, not a whole lot of adjusting on this strategy, because it'll throw everything out of whack on you. I'll usually just cover it for, like, I'm paying, let's say, $1 on a $3 wide. That's risking 1 to make 2, right? If it goes down by, my debit goes down by 50%, that's where I'm usually looking to cover that strategy for a lower risk tolerant person. All right, so we've kind of determined we've got high volatility, right? I already said mine was 72 percentile or something like that, right? So I've got the 72 percentile. That is above 50. Anything above 50, we want to look to sell premiums. And if we're looking to sell premiums, we want shorter duration, right? We want theta to be on our side. We want to streamline. We want to get there as fast as we can. We're going to not stop and smell the roses. We're not going to go and look at the great ball of yarn. All right, so when buying an option, the strategy wants to limit theta decay. Well, we're doing a long call butterfly that leads you to believe we're buying an option because we're paying a debit. I already said it doesn't work out with this one, because we're selling at the money. So we want to, when you're doing a long call butterfly, you have to think about it. I am paying a debit with this strategy because of the in the money that I'm buying. So, but the ones that are going to decay quickly are those at the monies, and I'm selling 2 at the money calls. I'm selling 2 at the money calls. So I want this theta decay to happen. Remember, when we were talking about theta and all of the vega and everything else, we could see that the underlying was in the option montage. We can see that vega affects these ones that are at the money the most. I'm going to be looking to sell these options. All right. Theta is going to affect me the most, so I'm going to be taking advantage of that. The ones that I'm buying aren't going to be affected as much as theta and vega. All right, so I want to take advantage of the volatility being lower out here, the theta being lower out here, and the ones that I'm buying, I want to limit that, right, and exploit it on the ones that I'm selling. All right. So I've got a neutral assumption. I want to take advantage of high volatility. I could do stuff like an iron condor or something like that, but I truly believe it's going to stick right in and around. For some reason, for whatever your reason is out there, you've got a strike that you have a pretty good feeling that it's going to land right there and kind of stay within a certain range. It's going to stay within our wings, which is what we want. With a long call butterfly, we want this to stay within the wings. All right, so specifically, a lot of people will go out there and tell you that that you could even be doing out of the money. Some people will say you're doing all out of the monies here, or whatever. They're just basically saying you sell 2 of the same strikes, and then you define the risk by buying, a little bit closer to at the money, in the money, however they might say it. But for me, I like the at the monies because I want to take advantage of that massive premium when we have a huge volatility. So we're going to be shorting, you're never getting an exact 50 or an exact 80, but basically this gives you an idea of it. Also, when you sell these, you're selling 2 at the monies, right? When you get that collection, it's whatever that at the money is, the premium, you want to double that, and that's how far your wings are. That's another quick way to think about it. But ultimately, we want to risk 1 which is our debit, risk 1 to make 2. Risk $1 to make $2, or risk $10 to make $20. All right. So risk 1 to make 2. But when you're selling the at the monies and you're building that out, it's kind of take that premium that when you've sold those 2 at the monies, toss doesn't double it for you. Like you hit sell 1 and sell 2, that premium stays the same. But when you sell it, that whatever that premium is, double it. And that's about where your wings are going to go. So I collected $6 for selling those at the monies. I'm looking at $12. So I'm looking at somewhere between $10 and $15 further out on the wings. Did I lose anybody there? So we're kind of looking, and it usually ends up being right around the 80 and the 20. So here's an example that I used. See, I pulled this screenshot off during the open market operations. You can see it's pretty close to what we were talking about, that 30 cents. It should be about 26 cents, but pretty close to that 25 cents, which is pretty in line here. So when I sold these 2 at the monies, all right, you can see this is the strike that I sold. Let's just say I collected $15, right? I hit the sell. It's right around $15 for these 65 strikes, right? What did I do? I went, you can see, I went $30 wide, right? From the 65s to the 95s, that's $30 higher. I just doubled that premium I collected. Now, something to note, right? If I built this strategy out in low volatility, I could sell those at the monies. And it could, in another world, when we had low volatility, these at the monies, these same at the monies, if I was like, say, 10 percentage points lower than where we are, or 15 or whatever, know that our premiums are going to be much less, right? Those premiums would probably be about, well, I can figure it out for you. If they're $10 less, right? We already figured this out. If it was trading around 39, well, that's 10 percentage point, $3.50 lower. So if we were much lower on implied volatility, those would be $3 less. So I'd be looking at, the collection of $10. So I would only be able to go $20 to the wings, right? Much narrower band there. That makes the tent. That would make the tent right now. We're looking at, if this is our break even, right, or whatever. But Trevor was talking about is our tent looks more like that, all right? Versus if the volatility was much less, then our tent would then look more like this, all right? It just squishes in, all right? So why we want, when we're doing a long butterfly, we want high volatility, because it stretches our tent out, all right? It flattens it down a little bit, all right? Whereas when we got lower volatility, those premiums are much less. We can't get the wings out as far, okay? So it brings our break even, everything in on that. Does that make sense? So here's an example, actually. So this is our setup with Baba, right? Same setup. You can see my break evens are the I'm getting a little ahead of myself, but the debit on the call side, in the money call side, it's our debit, and plus that, our strikes plus the debit is our break even, right? And our call to the upside minus our debit is our break even to the downside, all right? Now, this is it with a stock that has high implied volatility. Now, with a stock that has around the same pricing, okay? To give you about the same pricing, I took Amgen and sold the at the monies. You can see I was only able to go $15 wide to get that same risk 1 to make 2, all right? Still risking 1 to make 2, but you can see how much steeper this is as compared to this, right? Don't get confused with the chart. It auto adjusted there. But you can see it's much more flattened out. Do you consider the expected move for the term? Good question. Expected move tells you, volatility tells you what the expected move is, right? That volatility is telling me what the expected move is right now. And if I've gotten it where I think that the implied volatility is at its highest, no, I don't really care about that expected move, because as volatility comes down, that expected move is going to start coming down as well. All right. When volatility is at its most expensive, it's telling you it's having the biggest range expected since, since the data we're compiling existed. All right. So I am always looking at volatility as when it's really high, I expect it to come down. So I don't really look at the expected move for that. All right. All right, we'll dig into this a little bit more. All right, so we've got this, right? When we have a neutral assumption, right? We've got a neutral assumption. We've got the destination BABA, and BABA we know is a yellow light for this. But my rule for the destination is, if it's greater than $100, right, we move the decimal 3 ticks to the left, and that's what it ends up being for ours. BABA is should be 26 cents, right, for our example. And that's a green light. If it's less than $100 here, then we want it to be less than or equal to 10 cents wide. All right. Our environment, we want high volatility. Why? Because when you're doing it, a call butterfly, a put butterfly, and you're doing it from the long side, you're selling those at the monies, which have the most premium, have the most volatility in them. So the butterflies, like I said, environment is high. Yes, we're going to look to be doing a long butterfly. So that's where it gets a little bit flipped. But that's because we're selling the at the monies. That's where we are going to see this strategy work out, is when volatility comes down, theta erodes those big fat premiums. Well, when that goes down, then that allows us to sell this out for a much better, for a much higher premium than what we got into it as. Duration. We want to be about 35 days to expiration. We talked about this. Why? And this is on the long call fly. All right. 35 days to expiration. Why? Because we want that theta component on those ones that we're selling at the monies. And our strike locations, we want to risk 1 to make 2. All right. Risk 1 to make 2. And why? Why risk $1 to make $2? Why is my risk so low compared to my reward? Well, because it's a lower probability strategy. Therefore, I need to have a much better reward on this trade, okay? Because there's a possibility it could go out there and hit those, right? We could have a move happen. All right? All right, so our max profit is not the premium paid. Our max profit, I've got these backwards, profit, and max loss is the premium paid. Max profit is going to be the in the money. Basically, it's the width of the spread, right? The width of the spread. When I'm talking about the width of the spread, also what I'm talking about here is the width of the spread is between these two, so $30 wide, right? And the reason why I've gone with the in the money minus the at the money is so you don't get a negative. All right. I did the in the monies, to the out of the monies, so we don't mess that all up. But basically, it's the width of the spread minus the premium paid. That is our max profit, right? The whole credit. Our break even is the at the money call minus the net premium, and our in the money call plus the premium paid. And I kind of already went over that with the option montage there. So I'm going to go over a couple here in a minute, just to make sure everybody's clear of concept. So this is the long call fly, right? Long call fly. And we know that we need to risk 1 to make 2. All right. Risk 1 to make $2. So we've got that down. On a winner, what are we going to get out of on a winner? Basically, you guys, I'm looking to get out at about 30% of max profit. All right, 30% of max profit. On a loss, if it decreases, if that debit decreases by 50%, if you have a low risk tolerance, that's where I'd look to get out, right? For me, I'm probably putting this trade on and letting it ride. If it's Google or something like that, where I put up $10 or $20 for this strategy, then I might look for a 50% reduction. On something less than $100, I might look to just take that whole trade as the risk. All right, so let me try and pull up another example real quick, just to make sure you guys are all clear of concept here. Look, you can see I did pick BABA. It has one of the higher probabilities there. I just want to see if I move the decimal 3 ticks to the left, $3 wide. You can see $3 wide is fitting that rule for me here, right? $3.05, okay. But you can see it's fitting the rule pretty much across the board there. So that fits my rule even after open market operations. And I also picked BABA because there's no earnings in there. Do I have a strong assumption that it's going to trade sideways? No. But when we're building this strategy out, I'm just going to go with this one again. So this is what I'm talking about. You see the option montage, pull it up, $14.50. Now I'm just going to round it up to 15 and say, all right, 2 times that 15, I got to sell it twice anyway. But now that 15 is $30, right? So now I'm looking at $30 to the downside. So I'm going $30 down. So I'm looking at the 35 strike. That's where I'm going to define it. And $35 or $30 to the upside is those 95s. All right. So now I have to look at the debit paid. $10 for a $30 wide. That's risking a little bit less than 1 to make a little bit more than 2, right? So see how I did that? Basically, I'm looking at this. Okay, I've got $15. I got to double that and move my strikes out there. And you can see it lines up about with the 80 delta, which I talked about before, and the 95, which lines up as the closest around that 20 delta. So, those deltas just give you a little bit of information there. Do I ever look at volume and open interest? Almost never, because I know if it's pretty much fitting my rule of a green light and possibly a yellow light, especially with a higher price one, I know that it's going to follow suit. All right. I know that if those bid offers are tight, it means that free market price discovery is in full swing. And if free market price discovery is in full swing, then I know I've got the best markets I can have, right? It's like if the markets are really wide, you can think of it as like you go to the, and I almost always use this example because I think it's one of the best ones, but you go into the farmer's market, right? If one guy is selling apples at the farmer's market, he's not going to adjust his price on those apples. If there's 10 people selling apples, then yes, he absolutely has price elasticity, right? Because he wants to get rid of his inventory. He knows that he's up against a lot of supply, right? So he's willing to adjust a little bit. And if you can see here, so one of the reasons why I used this example was because BABA, has pretty high implied volatility, we determined. And if you go down here and look at, I think it was Amgen that I looked at, you can see that its volatility is pretty low, okay, for itself. So, that's also bringing that tent in narrow. All right. But again, you know, you could see that even with this one, how I figured out the strategy was basically you go to these at the monies, wherever the 50 delta is, probably the 37s is my guess. No, the 35. So let's go with the 35s. You sell that. All right, we've got $8. Now that means $16. Well, that's about $15 down. 35 minus 15 is the 20s. So buying that one, and 15 to the upside is the 50s. Buying that one. So $4, $4 plus, a little bit better than risk one to make one, but you can see that I'm only $15 wide versus $30 over there in Amgen, and you could say that those are pretty darn close in pricing, right? And that's because the volatility is really low here. It's bringing all that in. If volatility was 10% higher, or even 20%, if volatility was trading at 49 for this, well, that would be another $6 in there, right? We determined 1 percentage point increase is 30 cents the premiums. Well, 10 percentage points is 10 times that, $3 going in there, right? See how much those premiums are jacking up? You know, whereas the ones that I'm buying, that premium's only going to increase by, you know, $2.40. So all in all, those ones that are at the money are going to be affected more. Does that explain that? And why the butterfly is a little bit different? All right, so your debit paid, we can look at this on the Analyze tab. You'll see that it's much steeper. All right, it doesn't look like it here, but anyway, so our calls right there were long calls. It's the debit paid plus the premium, so our break even moves a little bit higher right here. You can see it's trying to lift my pen off of it right there. It's going to be basically 123, 124 area. And to the upside, you can see our break even right there is going to be basically 146. All right. On all of those. Any other questions? Pretty simple, but idea, high volatility brings those wings up, because when you're getting that big, huge premium on selling those two at the monies, it gets it further away. And I only set these up where on the call butterfly, the put butterfly, long or short, I'm playing those on the at the monies there, all right? For different reasons, but that's how I'm setting up my butterflies, is right there. I'm not trying to pick, you know, I'm not trying to say on the chart, all right, I think Alibaba is going to go up here to the 160 strike, so I'm going to go over to the option montage, and I'm selling these at the monies on the 160s. I'm not doing that. I'm not going to do that and then trying to find the risk by doing something like that. That's not how I roll. All right. I mean, you're paying a debit of 80 cents, but if that goes up there and hits, yeah, I get the width of that spread, right? Minus the debit paid. If it lands right on 260, but if I were to buy those 260 calls, and I wouldn't do it in this option montage either, but if I thought it was going to go there and I had low volatility, then I would probably just go out there and buy those calls or buy a call spread. Gives me a lot more room to be wrong, right? I've got limited risk and I got completely upside potential, right? Low probability strategy, complete upside potential. That risk reward is much better, all right? So that's why I would pick a different strategy if I thought it was going to go to 260 exactly. And I've seen people do do webinars on, look, if you would have picked the 260 strike for this iron butterfly or this call butterfly, you would have made 687%. You know, what? No, that never happens. Like, I mean, talk about cherry picking a trade. That's not how trading works, you guys. Nobody ever picks the bottom or the exact high or the settlement. Right? The likelihood of that are slim and none, and Slim just left town. All right, guys. One of the last weeks we're going to be doing this. Members count is closer to about 30 now. So if you want to become a chartered member of the option program, get in there now. I've got the, I'm going to send out the link right now to you guys. You can check on the link there. Listen, this is pages of scrolling of content that you get. And if you do it for a year, if you do a year, I'm going to give you another 50% off at $4.95. All right. So it's 50% off the year. Okay. You're also going to receive automatic upgrades and free access to a lot of the different content we're going to be offering with discounts, everything else that you get there. And you get the options lab question and answers. All right. And it doesn't even, we have no office hours in there. And that's just so that hopefully nobody really squeezes me too much. But I've got somebody that is over in Japan and we do off hours. So if you reach out to me with a question, I will get out there and try and answer you as soon as humanly possible. All right. So you get unfettered access to me and more. We're going to be doing other things where we're doing podcasts and stuff like that with some special guests that you guys will get invitations to and free access to as well. So all of that stuff included in there for a huge discount. You get unlimited access to all of the content we've looked at. So when I say watch this webinar again, you don't have to necessarily watch the one on the roadmap. You can watch one of the other previous ones that we've done on the long call, because you guys, long call butterfly, because you guys drive the content. You know, we've seen the questions come out. I can guarantee you the questions that were asked in this webinar weren't necessarily asked in one of the other ones. So if you were too shy to ask a question, it was probably even asked in one of the other ones. I would say, please reach out during these, because I want to make sure everybody's clear of concept. So hopefully nobody's held back. But yeah, you can take advantage of this by clicking on this link in the chat window or typing this into your URL. Thank you guys all for participating. I see a couple questions popping up. I'll get to those here in a second. Here's also the link. Later webinars will drill down on different option components, when and where I find those. If you have any questions, comments, or ideas for future webinars, reach out to us at 310-598-6677 or trading at protraderstrategies.com. Finally, yes, we do have a disclaimer we need to talk about, ladies and gentlemen. There are risks to trading. So please know your risks. Everybody's risk parameters are different. So know what you're getting involved in before you get in there. So if you're watching on a tape delay, pause now and take a moment. All right. So do you look at volume and open interest? I think I already answered that, right? I just saw that show up. I usually look just at the bid offer. I'm trying to streamline your process, you guys. You know, just like that question, do I look at volume and open interest? No, because I know that if I look up there quickly, I can easily move the decimal 3 ticks to the left on a $3,000 stock. I know it's $3 wide. Boom, look at $3 wide. $150 stock should be 15 cents wide. All right, boom, looking at that. I just do that. All right. Maybe if it was trading around 20 cents, I'd go over there and look at it because it's a yellow light. Maybe I'll look at that. But usually I just know, hey, I got a yellow light here. I can't have too many more of those before I start kicking this underlying to the curb and not trading options around those. All right. So with this one, we want high volatility, specifically for a long call butterfly. Why? Because on the long call butterfly, it's a little bit freaky because we're selling those at the money premiums. That's what makes this strategy work out. When volatility comes down, those premiums on those at the money contract much faster than those ones that we bought, and it helps us out. Because we can buy those back cheap, right? And we can still sell those out of the money and in the money ones for a decent premium. So the ones we sold go down faster than the ones we bought. So that helps us out with that strategy, get out of it much quicker. And remember, I'm only getting out about 30% of max profit. So, and that's a pretty huge max profit, you guys, right? I mean, you're risking 1 to make 2. So that means I'm trying to make 2 on this trade. I'm trying to get out for, you know, basically, what is that? 65 cents or something? The top of my head. Pretty close. So in that case, you know, I paid $1 for it to risk 2. I'm getting out at $1.65, right? All right. Well, if you got your guys' cameras up, I'm going to give you the thank you guys very much for participating in this. I know JQ's been waiting for this all day. He's been quiet in the corner. But if you can't take that, take it easy. Bye for now. Thank you, Alexander. Appreciate it. Appreciate it. JQ, you're really getting slow on it. You weren't paying attention. All right, guys. Thank you guys all for the kind words. Bye for now.